Hey everyone, we're excited to have everybody today for our monthly Food for Thought. And the reason I'm excited is we have not only our Chief Investment Officer, but another special guest, Mr. Ken Frier. What we're going to be talking about today is what the election can mean for your retirement. I would tell you, not just myself, but every advisor that works at Lake Point, probably the number one question that we're getting right now, because there is so much noise and news and when it comes to this election. And there's a lot of other things that are going on top of all of that. So we're going to try to answer some of the questions to the best of our ability, and who better than the people who help make the investment decisions to me to kind of ask questions about what's going on. We have a super large audience today. We want to thank you for joining. Everyone's camera and microphone is actually off, but we will be taking questions. If you'd like to type a question in, there's a little chat feature down at the bottom. I will be checking this chat feature, and I'll go over that one more time towards the end, and we'll try to answer as many of your questions as we can. Today, we're glad to welcome Rob Emrich and Ken Frier. A little bit about these two. Rob, you've seen on another Food for Thought with myself. Rob is actually Lake Point Advisory Group's investment, not only our investment committee, but he's our Chief Investment Officer. He and his team actually are involved in developing and managing our investment strategies, your investment strategies for the individual portfolios that we manage for you folks, which include hedging market and trying to reduce the volatility when possible. Rob actually has been quoted in Reuters, Yahoo Finance, Business Trader. Last night, he sent me a text message. He's like, Reid, look, I'm on TD Ameritrade's platform. You see him on the news all the time. We're super excited to have him. Just a quick note about him. He lives in Austin. We try not to hold that against him, with his wife, Nicole, and their two children. Ken Frier, on the other hand, Ken is a really valuable resource for Rob and his investment team. He has over 30 years investment management industry and experience, including, folks, and I want you to catch this, Ken was actually the CIO of Chief Investment Officer of Walt Disney, Hewlett-Packard, Stanford Management Company, and UAW Retiree Medical Benefits Trust. Ken holds a BS in mathematics from the University of North Carolina at Chapel Hill. He has an MBA from Stanford University, and he also has a chartered financial analyst designation. And folks, that's a mouthful. So guys, welcome. Thank you for being here today.
Thank you.
Awesome. Well, I'm going to kind of just jump into some questions. I took some questions from different clients that I've kind of had, and I had some of the other advisors put some of the questions that they've been seeing from their clients. And so I thought I'd start off with you, Ken, since you're kind of new to this Food for Thought format. I wanted to see, what are your expectations? Should we expect a good or a bad market based on who gets elected?
Well, thanks, and I'm happy to be joining this group today. What I think we should all be calm about the election outcome. Clearly, this is a presidential election that is probably exciting a lot of passions on both sides, and people fear about what might happen if their favorite candidate doesn't win. But if we look at economic history and stock market history and political history, what really matters for the outcome of the stock market is the economy. The economy drives earnings, earnings drive stock prices. The fact of the president being a Republican or being a Democrat, it hasn't typically mattered very much. And we shouldn't worry that much about sort of major changes in the economy if one party takes over the other, because it's typically very hard for either party, even if they control the House, to do more than one big thing. It's hard to do anything very radical. If we look at US history, the outcome of the stock market and the economy on average has been a little bit better when Democrats were in charge than when Republicans were in charge. But I think that's more of an accident of who just happened to be the president at the wrong time. The big recessions that we've had since World War II, the three biggest ones were in the early 70s when Nixon was president, in 2008 when the second George Bush was president, and the one that we just had with Trump as president. So the three biggest recessions happened when a Republican was the president. But I don't think we should draw a conclusion from that, well, we're more likely to have recessions if a Republican's in charge. I think instead that it's kind of an accident that we would have had the COVID crisis even if a Democrat occupied the White House. So it's more that the president happens to be, in that role when, the economy does well or badly. We often give the president credit when the economy is good and blame when the economy is bad, even if it isn't deserved in either case. But by and large, they're the sort of accidental stewards of the economic situation that happens on their watch, rather than the cause of it.
I like that word that you used, accidental steward, because I mean, this is really emotional. I mean, I will tell you, I mean, we live in a very conservative area of the country, and, there's a lot of concern with what's going on. And so I think that the first thing that I would have pulled from what you said from that is the fact that, that there has been a lot of different changes in political stature, and the market continues to go on. There's some other things we're going to talk about that maybe couldn't be impacted by this election, but I think the first one that I heard is that sometimes the economy that happens during presidency is an accidental steward of other things that are going on in there. So hopefully we'll try to address those things today that can possibly affect that. So great. Rob, it feels like this election is different than any we've seen before, right? Is it different?
I would say it is and it isn't. It isn't in the sense that when you're going through it, it always feels different. And then when you look back historically, you say, that wasn't so different after all. But what makes this election a little different, I was running money during the 2000 election when it was contested. And this feels a lot like that environment. The only difference is we're talking about the potential for a contested election before it happens. Now, one of the jobs of the investment committee is for us to think about outcomes that we'd rather you not think about, but we think about them in terms of what could the effect be on the portfolio. And we might have a scenario, just looking at the data, where Republicans are going to be more likely to vote in person, based on polling. Democrats are going to be more likely to vote through the mail. So we may have an environment where on election night, in fact, there was a report issued by Goldman Sachs where they said this very same thing. Election night, we may have a winner. It could look like Trump is winning. It might even look like a landslide. But 2 weeks later, as we get all the mail-in ballots in, it could completely flip. So that could cause some volatility, and we are already prepared for that. So in that sense, I think this election is a little different because lawyers are lining up on both sides of the aisle before the election's even taken place. So that's truly unprecedented.
Wow. So yeah, I think that it's not going to be just about because I've heard somebody even as early as this morning, I was talking to a client and she said that, she's hearing on the news that there's going to be a big drop in the market, as far as in October. It could be before, it could be after. I mean, if the election, completely changes, I mean, if there is a change. But I think that the one thing that I always, that not just from you talking with you guys, but other people, I mean, without that magic crystal ball, it's very hard to determine that. And so what I'm going to probably use as a constant theme through this meeting today is basically saying, you have a financial plan. The worst thing that could possibly happen is not sticking with that plan, trying to predetermine what the market's going to do. And unless you have that magic crystal ball, I think that that's where people can get hurt. So I like what you said there. One of the things that when I'm sitting down with families and talking with them about their portfolios, is I talk about this is almost a perfect storm right now. And what I mean by a perfect storm is we have historically low interest rates and inflation. We have historically high markets, historically high debt, and historically high unemployment. Add this to an election year and a virus that we still don't have a cure or vaccination for. I mean, what should you do? And Ken, I'm going to kind of pose that question to you.
Yeah, it is definitely a challenging time for investing. The yield on bonds has gone down to rock bottom level with a 10-year U.S. Treasury note yielding only 70 basis points. But what we should also recognize is that not only does that make it less attractive to invest in bonds, but the prices of everything else has adjusted accordingly, and it's made it less attractive to invest in stocks, in real estate, in the other assets that are available to us. If we look at the typical valuation metrics for the stock market or for real estate, they're about as unattractive as it ever gets. So we have that observation. And on top of that, we have the observation that we're not necessarily out of the woods with respect to the global economy or the US economy. At the height of the downturn, 22 million Americans lost their jobs when we were at maximum lockdown. And now the unemployment number, the new unemployment number is about 11 million. So about half the jobs that were lost have come back. But what we can see from the data is that while we're halfway back, the amount that's still to go is a large amount, the other half of the way, and we're still farther down year over year now than we were during the prior worst recession, the global financial crisis. So we're still in a hole. And the big question for investors is, does the recovery continue from here or does it stall out? And the two most important variables with respect to do we stall out or do we keep recovering are the progress of the virus and the remedies against the virus. We're starting to see cases go back up in the US and they're going back up in Europe. So in advance of flu season, that's a worrisome sign. The other really important thing we should consider is the fiscal measures, the government spending. In the first month of the COVID crisis, the CARES Act was passed, and that was more than $2 trillion that was sent, immediate spending power in people's pockets. So even though we had a record number of unemployed, spending didn't actually go down that much because consumer income was going up. Those programs have, for the most part, come to a halt. And so if there's no replacement fiscal package, then the income that helped with the recovery that we've had so far is going to be greatly diminished. So there's this risk of the economy backsliding because the program that was great for the first months of the recession doesn't get renewed. You can see Jerome Powell, the Fed chairman, in his testimony this week saying, please, we need a fiscal package because we in the Fed can't do it alone. So I think in this period where the valuations of everything are on average historically unfavorable, and you have the possibility of not a V-shaped recovery, but more of a W-shaped recovery, where having come up, we start sort of backsliding. It does make it somewhat treacherous to take risk in markets. And so I would err on in my range of sort of acceptable risk postures, I would tend to be more on the lower end of that range.
Okay, so more of a defensive type of positioning. So Rob, speaking, I mean, I've had the same kind of feeling. I know a lot of clients that I've talked with and families that I work with have said, and the advisors that we work with and their families have said the same thing. So, you being our chief investment officer, the head of the committee, I mean, what are you guys talking about? What have you done to our portfolios or to these people that are watching today, their portfolios, to basically help with this, where we're at right now?
Yeah, the key thing here is, if you had to evaluate our portfolios on equity exposure, I would say we're on the lower end of that. For all the things that Ken mentioned, we will not get out of equities. I mean, if you want good returns long-term, you have to be in equities at some point. I would add to Ken's comments, we have the most accommodative Fed in the history of the world. I mean, it's unbelievable. Who would have thought that, after a COVID crisis hits the planet, that we would be up 50% from those lows in March. I mean, it's unbelievable. So we have a very accommodative Fed. So what we do is we say, well, look, while some areas of the economy aren't doing great, there's some that are booming. I mean, we're seeing a dynamic shift in our economy right now, right before us. So what we do is we say, hey, look, we're not really going to pick what's going to work because we don't know. Who would have known, back in February that companies like Zoom, that we're hosting this meeting on, would go to stratospheric highs. So what we do is we diversify the portfolio. We diversify across the fixed income spectrum. We have different fixed income managers. They can buy foreign debt. They can buy lower quality credit debt that can appreciate as the economy gets better, or will do well with an accommodative Fed. We have a little bit of gold in there, which can do well if monetary policy continues to go off the rails, so to speak. We have small caps, mid caps, large caps. We have international exposure. So these portfolios, I couldn't be more pleased with these portfolios. I mean, these are the portfolios. I mean, this is what I have my money in. This is what my mother has her money in, these exact portfolios. So we're very, very pleased with how we built them. And the key word would be diversification. These portfolios are very, very well diversified.
Yeah, I think that's an important feature. And I think that's one of the hardest things to articulate, the importance of diversification, because you hear that all the time, that diversification is important, but what does that mean? And, you know, and for me, when I look at it, I kind of look at, we show a lot of the families we work with, like this periodic table of investments, and show the different asset classes and how, you know, US large caps have been phenomenal the last decade. But if you look at the, you know, the decade before that, there were tons of other asset classes that were positive, especially in 2000, 2001 to 2002, when US equities were, you know, destroyed. There were multiple, you know, different investment or different diversification pieces that you could have been that were positive. So I think that the point of this is that the team, you know, obviously Ken's saying be more defensive. You're saying that we've maneuvered these portfolios more defensive, stayed diversified, and basically have things that just because the market, what the news calls the market is going down, there's things in your portfolio that could actually be doing the opposite, correct?
That's exactly right. Exactly right. And that's what's occurring. That's what's happening now.
Awesome. Well, Ken, before this webinar, we were talking about something that you call, it's called the misery index. And I thought that was interesting to bring up today. So can you tell us exactly what that is and what it tells us about the market, if anything?
Sure. So I was looking at the performance of the stock market at, you know, in relation to presidential elections. And what it indicated was that when the party in power changes, so we switch from a Democrat to a Republican or Republican to a Democrat, the stock market doesn't tend to do that well in the year following. So then you have the question, well, does that poor performance of the stock market after the election mean that the stock market doesn't like the change of party in the White House? But instead, I think what it is what I'm calling the misery index. Actually, I didn't coin that phrase. It's been used for a long time. The misery index is just a simple sum. You add the unemployment rate in the country, which I think is about 8.4% now, and you add the rate of inflation, which is just under 2%. So the misery index right now would be about 10. What we can see historically is that if the misery index is rising, then the party in power in the White House tends to lose the White House to the other party. And if the misery index is falling, then the party in power usually keeps the White House. Because as I said before, voters, whether rightly or wrongly, they blame whoever's in charge for the economy that they're witnessing. There are other observations like that as well. If the stock market falls in the 3 months leading up to the election, so in the like April to November timeframe, then the party in power usually loses. And if the stock market goes up in 3 months before the election, the party in power usually hangs on. After the election, regardless of who wins, the stock market tends to go up. So we shouldn't make a bet on stock, even if we thought we could perfectly predict who wins the election. It may not make that much difference afterward. So I think what we can observe historically is that the voters, we blame the president or credit the president for the economy that we witness around. And if we like what we see, we keep them in office, and we don't like what we see, then we tend to boot them out.
So it kind of works how it's supposed to, I guess. It's, you know, obviously go out and vote. You know, Rob, you know, so one thing that I think that I hear all the time, and we talk about all the time, is volatility. You hear it on the news all the time. It's there. So, you know, is there a way that you could actually talk about volatility, maybe explain it so that my second grader, Kelton, who's 8, could understand it? He's very interested in money. Can you, I mean, at a simple level, can you explain volatility? And then more importantly, what is it, and is it good or bad for your portfolio?
Okay, I got to think about that. All right, for
Kelton.
Second grader. All right, yeah, all right. So if I hop in my Ram 1500 pickup truck, and I drive up the street, let's say I take a 10 or 15 minute ride, it's going to be, I mean, these trucks nowadays, they drive smooth as cars. You know, we're going to get there. You could probably take a nap on the way, and we're going to arrive safely. On the other hand, if I let my 17-year-old son, who recently got his driver's license, there's some new thing now I can't understand where kids wait forever to get their driver's license. When I was 16, I ran out and got it, but that's not the case nowadays. But nonetheless, if he's driving, it's going to be a lot more volatile ride. In other words, he accelerates a little too quick sometimes because he's a new driver. He hits the brakes too early, too quick, too hard. He turns too fast, so you swing around. So if I was talking to your second grader, I would say, look, you ride with me, that is a smooth ride. Riding with my son, that's volatility. Bouncing around the truck, coffee spilling all over the place. You couldn't set an egg on the dashboard with him driving. It would fall off and smash against the windshield or maybe even the back window. That's volatility. That is volatility. Now, volatility is not bad. I happen to like volatility. Why? Volatility allows us to exploit extreme moves in the market. So in other words, if we see extreme moves in the market, we can reallocate into some of these areas at a lower price. So we think volatility is actually good. Now, it may not feel good watching it. It may not feel good being in the car, but I can tell you, my son, while it is a little rough, you're going to get there safely. He's a very good driver, very good driver. So while volatility is scary, it's necessary. It's necessary for these markets to grow and to compound wealth over time.
So basically I kind of think about what you just said is it's like you have to get somewhere, if you have to get to another location, you can either, inch your way along, or you can take something that's going to have some ups and downs, and you've got to be prepared to basically go through some hard times. And at the end of the day, you're going to get there more quickly, more efficiently, while it might not have felt good. Is that kind of what you're saying there?
That's exactly right. That's exactly
right.
Perfect.
If you're just joining us, I've seen quite a few people jump on today. You have myself, I'm Reid, the president of Lake Point Advisory Group. If this is your first time on one of these Food for Thoughts, thanks for joining. We have Rob Emrich, who just was speaking. He's our chief investment officer, and he leads up our investment committee for our client portfolios. And then we have Ken Frier he is a friend and a resource of where we get information for our investment committee. He actually was the chief investment officer for Disney Corporation and Hewlett Packard, and has a wealth of knowledge, and we're thankful to have both of them here today. I'm going to lead this one back over to you, Ken. What are the major differences on what pundit, so what, which party particularly expect could happen depending on which party takes office? So what, if X party gets it, or if Y party gets it, Democrat or Republican, what are kind of the expectations of the market, if anything different?
Yeah, so I'll focus I think we have a good idea about the priorities of the Trump administration. I think if Trump remained as president, he says he's going to cut taxes, but there's not a clear plan yet whether that will happen or not. He probably will continue to have, trade wars with other countries, so that could be sort of challenging for multinationals. It probably would be a lower regulation environment with Trump, and he would leave corporate taxes low, and so that would be good for profitability. If we look at a transition to Biden being president, I think first we need to recognize that that politicians will offer a lot of scare talk before the election. Is if Biden takes over, then he's going to do just what like Alexandria Ocasio-Cortez says that they should do. We should recognize that I think that the framers of the Constitution wisely set the system to make it really hard for major changes to happen. And if we look at the experience of the last two presidents, Barack Obama was able to do one big thing, that is to enact the Obamacare, and
affordable health care. Yeah.
Okay, affordable. Yeah, and then he lost the House of Representatives and couldn't really do big things after that. Then in 2016, the Republicans had as their top priority getting rid of the Affordable Care Act, and even though they had a majority in every House of Congress and had the presidency, they, even though this was their big thing, they weren't able to do it. So it's just hard for the president and Congress, even if they have the same party, to do anything big. We should recognize that even if the Democrats manage to take the Senate, which is sort of a 50-50 thing based on the polls, that they would just have the tiniest of edges in the Senate, maybe 51-49 or something like that. And so the moderates, and if they have the majority, there's going to be Democrats from moderate states like North Carolina or Arizona or Colorado, And they're not going to sign on for any kind of radical left-wing thing. So we shouldn't expect that, even if there's a democratically held Senate and House of Representatives and presidency, that we're going to get really big changes. But on the margin, I think what we should expect is there'll be some reversal of the tax reductions that were passed when Donald Trump was president. I think you'd see personal income taxes go up for the very wealthy people over 400,000. You'd probably almost certainly see corporate taxes go up as well under Biden's administration. And while that sounds like, that definitely is a direct hit on profitability. If we look in American history at other times the corporate tax rates have gone up, it hasn't actually led to a problem with the stock market. If you think about Biden's priorities, after having raised taxes on the most wealthy Americans, he's more likely going to favor the less wealthy Americans, so that could be good for consumer spending. He also is going to favor, the Democrats are sort of more friendly toward state and municipal governments and the challenges that they're facing right now. So a Biden victory is probably better for the muni bond market than a Trump victory would be. There's a lot of sort of enthusiasm about green priorities under the, among the Democrats. So I think you could expect more investment in renewable energy, alternative energy, and that kind of thing. So you also probably could expect more spending in general by the Democrats if they controlled than you would have if you had like a Biden presidency and a Republican Senate. I think if it was a Biden presidency and a Republican Senate, the Republican senators would fall back in their usual comfort zone of being in opposition to major increases in spending. So we'd probably have less spending than if it was, controlled. So if there's more spending, then we do need to think about the inflation risk that's come up earlier in this call. Typically, historically, the recipe to create inflation is you print a lot of money and you have a central government that's spending a lot more money than is coming in. That often has led to recession. That's definitely what's happening, not recession, that's led to inflation. It's definitely happening at a large scale right now. Inflation has not really picked up. Inflation is under control. The bond market seems to expect that inflation won't get out of control. But in an environment where there's even lower constraints on spending than has seemed to be the case lately, then I would think that at least the risk of inflation picking up would be heightened. So from a portfolio management perspective, you'd want to try to have more real assets that might hold their value in a higher inflation world.
Yeah, so first of all, I want to make sure that everybody knows we are not recommending one president or another get here. The whole purpose of this meeting today is there's a lot of questions and a lot of uncertainty when it comes here. And so we're trying to give you the perspective of, if this person gets elected, if this person gets elected, there could be potential changes. But on both sides of the coin, if somebody gets elected, what I think is most important, and Rob, correct me if I'm wrong, is that you need to be able to be adaptable when things change inside of the market. And so where one sector of the market might get hurt, the other sector of the market, from what Ken was talking about, might actually benefit. And so being able to have flexibility, I think, in a portfolio is really important, and our team certainly has that. Would you agree with that, Rob?
Absolutely.
Great.
I think in terms of sectors, just to add to potential impacts, I think that a Biden presidency might be worse for the energy sector, for instance, because it'd be more regulation. Might be worse for tech as well, with more regulation. It might be better for healthcare. There's definitely an impulse among the Democrats to direct more spending toward healthcare. At least healthcare service providers like hospitals may be not good for like pharmaceutical companies, because I think it's bipartisan agreement that drug prices are too high. So it might not be good for them. But you can see how the priorities of the parties could play out in terms of which sectors do well and less well.
And that's why I think it's really important, that buy, hold, hope strategy. You know what I mean? I'm going to buy something, I'm going to hold it, I'm going to hope it's going to be okay. It can really be detrimental. And so, there's a place for passive management. There's a place for active management. Sometimes it's a combination like we have in portfolios right now. But I really like the fact, with our investment team and what they're talking about is that they're kind of looking out into the future and saying, okay, going into this, I mean, this is really close, right? And we have no idea which way this is going to go, but the portfolio is prepared to kind of walk into that. And one of the things that we've made a big change over the summer to all portfolios was kind of in the fixed income space. So Rob, what are anticipated impacts on interest rates and the bond market since we have made some significant changes there?
Yeah, I would think, this is confirmed by the Federal Reserve. I mean, we're going to be in a low rate environment, we believe, for quite some time. And we think that, the 10-year, I mean, I don't know if we'll see, 1.5 or 2% for a couple of years. That being said, while our view is that interest rates will remain low, we don't pin ourselves to that. We have, multiple fixed income managers, for example, Gibson Smith. I mean, he's very talented. I've personally known him and worked with him since 2008, where he ran the Janus fixed income department and built that up to 40 billion. And by the way, the position in your portfolio is called the ALPS Total Return Fund. He is phenomenally talented, as well as like a Doug Peoples, who runs the Alliance Bernstein portfolio that's in the account. And I know him personally. I've known him since 2006. It's knowing these good, smart people that have, decades of experience, that have seen multiple environments, multiple market cycles. It's allowing them the flexibility to adapt to a changing marketplace. So even though we have a low interest rate outlook, we always attach to that. We say, well, what if we're wrong? And what if it doesn't occur? So we leave ourselves flexibility so that if we're wrong, it doesn't hurt the portfolio. We've already got managers in place that can adapt to that literally on the fly.
Good. Very good. Ken, being a chief investment officer of major companies, I mean, like some of the biggest, I mean, my kids would go crazy if they knew, you worked at Disney. I mean, and probably not a fun Disney job, but, an important one for sure. And Hewlett Packard, what was the advantages or disadvantages, when you're making investment decisions versus, us managing individual family money? What would you say there?
Well, I did get to take my kids to Disneyland for free, so that was a good added benefit.
There you go.
But if you're an institutional chief investment officer, you do have advantages versus the retail investors, but you also have some disadvantages. I mean, the advantages are that you're a full-time investor and you have a team of full-time investors, as you have resources devoted to the problem that are really helpful. You also have access. If you're interested in a strategy or a manager, then they'll come to you, you go to them, you can, you get to know them as people, like how they think, you get to know the organizations from the inside, like how they operate. And so I found that it's helpful to make manager selection decisions through knowing how they operate and knowing the people. So that's another advantage of being an institutional investor. The disadvantage is that there's a structure that can sometimes be cumbersome for decision making. Typically, you would have a board or an investment committee. You would meet once a quarter. And so if you had an idea for something to do, then you could bring it up in a quarterly meeting. And then usually the board will say, oh, well, that sounds interesting. I want to hear more. And then the next quarterly meeting, maybe it gets approved. So what you can lack sometimes as an institutional investor is the nimbleness to react to market developments as they occur. And so I think that's potentially an advantage for individual investors is that they're their own committee. So they don't have to wait till the next quarter to make a decision. And if market risks or opportunities are right in front of them, then they can make a decision.
So you were telling me about when you were a big opportunity miss was at Hewlett Packard in 2009. I mean, how did that impact you? I mean, do you have any projection on them that the fact that they couldn't make a decision in 2009 when there was a big buying opportunity? I mean, the potential gain that could happen for somebody who can't make a decision as quickly.
Yeah, well, I like to refer to that one because this profession offers a lot of opportunities to be humble. So I haven't always been correct, but at least in this instance, at the trough of the market in 2009, I did go to the quarterly meeting. I said, we should buy stocks now. It looks like, the stock market is down by more than half. The economy seems to be at bottom and on its way back up. And so this is a good time to go back in. And the committee thought, oh, that's an interesting idea. Let's talk about it again in the next meeting. But the market went up so quickly, I think 20% or more between the meetings, that it would have been better to be able to act quickly. So that's the kind of nimbleness that it's just structurally difficult to do in institutional investors. Reasonably, the board doesn't want their investment team just acting like they're global macro hedge fund managers, and so it's you have a careful deliberation that goes into every decision, but it does make it hard to be fast sometimes.
Yeah, and I think that, while we operate like large institutional managers, having an investment committee, which is the benefit of that is the research, right? I mean, you have the resources of some of the smartest people out there when making investment decisions. And so we operate under that same capacity where, Rob, has a relationship with you and multiple other people where, he basically is helped getting information when we're choosing portfolios in there. But what I wanted to get out of that is I think the benefit is while we get the research, and that's something that makes Lake Point unique, is that we don't have to actually wait until the next quarterly meeting. We have the ability to move on the fly, which in a lot of cases, especially when there's a lot of volatility, could be a benefit. Would you agree with that? Rob?
Yes. Yeah.
Okay. All right. All right. So one thing that I think that makes us unique is the fact that we do have an investment team. A lot of times when you work with different firms, some of those firms, it's the advisor. They're going out making decisions. They go to dinner with different, fund managers that come in here and they like that person and they go make that decision. And maybe they had a nice little spreadsheet. We don't operate like that. I mean, I see all those books behind you, and I always tell people, it's kind of like going to the congressional library with 401ks, right? You have the ability to invest in maybe that little couple of books over there on the left-hand side where we have the full gamut that's there, and you're using your team and your relationships to basically pick the best managers that are there. So, can you talk a little bit briefly about that speed of process when we're making investment decisions?
Yeah, and I'll mention you reminded me of a good analogy that someone once told me. Books are great, right? It's great to have books you can read, but managing money is a craft. You can't read a book and learn to be a plumber. You can't read a book, learn to be an electrician or a doctor. You've got to do it. And one of the things that sets us apart from other investment teams is the experience we have of actually running money. What does that mean? It means we have guys like Ken and people, of course, Ken's not on the team, but we have access to his resources. I mean, in fact, when we took over Lake Point, I sent Ken, the positions that were in there and asked him for an analysis and what his thoughts were. And it's having that ability of people who have run money. Most shops do not have people that have run significant amount of money. On our investment committee, we have Joshua Wilson and Mike Reddington. I mean, Mike Reddington has been an analyst for, $10 billion hedge funds. It's a tremendous amount of money. And the good news is I talk to Joshua and Michael daily, sometimes multiple times a day. If we needed to make a decision, we can literally hold a meeting in a moment's notice and make a decision. Now, I don't think that'll happen, and it's hard to think of a circumstance where that would happen. But if it did, these guys are a text, a phone call away, and we can make decisions much faster than most organizations.
So again, if there's something completely crazy that outcomes from this election, I mean, we think that, while this seems very emotional, I like the analogy that you used. If you came on late, Rob was saying, while this seems different, it really is, if we look back on this, it's probably going to be different like it was for another election. And then we're going to look at it in the past and it was there. I think that when I'm really kind of getting down to what I'm concerned about with this election is that people are going to let the emotions that they have help them make bad decisions in their plan. I think another thing that makes us unique is the planning process that we go through. It's like, we understand when we're building a plan that the portfolio is not going to be up every single year. I mean, that'd be great. If we find a firm, we'll all sign up, right? If somebody can have a back record where they've never had one negative year, never made one bad, investment decision, I mean, everybody would sign up for that.
What's Bernie Madoff?
Oh, Bernie Madoff. Okay, yeah, they are out there, but they usually get caught because it's too good to be true. But the point of this is that if you're using traditional investments and you're really having a good investment philosophy, if you stick with the plan, Ken, I mean, I kind of like to pose that one to you. I mean, you know, is this something that you think somebody should stick to a plan? Do you think they should go to cash if they're worried? You know, or what do you think they should consider doing, if anything?
Yeah, I think that the standard advice, which I think is good advice, is that you should have a long-term plan and stick to it. Since I'm a professional investor, you know, I tend to like to have some wiggle room on the plan rather than sticking to exactly the same configuration, because things change about asset class of returns. For instance, I mean, when I started my career at Disney, the 10-year treasury yield was 6%. And so if I wanted to earn 7%, well, you know, it's just a little bit extra effort and there we go. I can get up to 7. Now, you know, with the 10-year treasury yield at you know, less than 1%, it's really hard to get to 7 if 7% is what you need. So we do need to have some adaptability of our portfolios, because the opportunity set is going to be transforming over time. But it's typically a better strategy to stick to some anchor point for your allocation and with some flexibility around that, rather than to grant yourself like full discretion to go, you know, all in on risk or all out on risk, because it's just too hard even for professionals to be accurate about making the grand decisions like that in your investment allocation.
Yeah, and so when I say stick with the plan, I mean basically you understand what the guidelines are, right? You know, I use the analogy of a football field, right? There's like, if you go out of bounds, you know that the play is over, right? But as long as you stick in those bounds, the play is still continuing to go, but you can move and you can make different changes. So I think having the flexibility, I agree with you with the investments is really good. And Rob, I think you would agree that we have that flexibility to make changes, but what I really want to try to get to the bottom of is what, and maybe you said it there with you know, trying to time going to cash, and then when are you going to come back in? Have you ever? I mean, I've had people in 2007 say, "Hey, I just felt it. I went to cash, and then I went back, bought in." I kind of wonder when they bought back in and what that would have looked like if they kind of wrote it out, you know. And so that's kind of, you know, hindsight's 2020. But do you think going to cash for people who are very worried at this point is something they should do, or do they stay with a good diversified plan if they work with someone they trust?
Yeah, you have to stay with the plan. And listen, especially in these markets, we literally have the fastest markets in the world. I mean, as I mentioned in March, you know, if you had chosen after the market sold off in March and you got out, when would you have gotten back in? Because it ran up so fast, you would have said, no, because what was everybody saying? Let's be honest. We were all saying, oh, it's going to test the bottom. It's going to test the bottom. And what did it do? The market just kept ripping higher. Bid. The market just got bid all the way up to all-time highs. It was unprecedented. I know so many people, not our investors, but I know so many people that have missed out on that, and they're kicking themselves because you can't go back in time and pick your point of entry. You've got to stay invested, especially now. We've got an accommodative Fed. The market could sell off again. I don't think it will. Could sell off again. Guess what? I think, especially in election year, the Fed's going to be right there to support it. You know, our portfolios aren't banking on that, but I can tell you from what we've seen, the Fed is very scared about this economy. It is delicate with the coronavirus. It is unprecedented. We've got an accommodative Fed, and we've got the largest economy in the world. I wouldn't expect it to be down for long, so I would not go to cash.
That's good.
Stick with the plan. Stick with your financial plan that you did with your financial advisor.
I think that's good advice, regardless if you're here or anywhere. I think that's really important. The last question is to you, Rob. So we're going to open this up for some questions. We got a little bit of time to still do. There's a chat box or a question and answer down at the bottom where you can ask questions. I see there's some questions there. Again, I won't be able to get all of them, but I'll try to get to as many as I can. The last question is to you, Rob. What have you and the investment committee done to prepare for this environment of an election, an unknown coronavirus, and that perfect storm that I basically talked about earlier?
You're right. The one thing we do is we stress test the portfolios. As I mentioned earlier, we are just by definition of being well diversified. You know, having a diversified portfolio is like having an all-season tire. So you don't say, hey, it's raining, are you going to change your tires? Or, it's sunny out, are you going to change your tire? No, this tire will go through mud. This tire will go through rain. That's these portfolios. But if I were to answer the question differently and say, what are we thinking about the future? What are our concerns of the future? One of the things that we're thinking about right now is if we do get into a period of prolonged volatility, we're looking at ways to add to the portfolio where we can benefit from that volatility. And this isn't something that's going to come in, be in the portfolio tomorrow. We're thinking, we think out in terms of 3, 6, and 12 months. We stress test the portfolios all the time. But that is one area we're thinking about. We think we could be in an area, as I mentioned, I was running money in 2000, from from October of 2000 through March of 2002, it was like 17 months. We had a period where volatility as measured by the VIX was in the 20s for the whole time, except for like 5 days. We're thinking that we could enter that environment again. If we do, we're going to introduce assets that can benefit from that.
Right. All right. Well, that's the rest of my questions today that I've kind of put together from the advisors and myself. Now I'm going to get to some of the people that are on this call right now. This one comes from Mr. Pemberton. He said, will you make any changes to our portfolios if capital gains go up?
If capital, so when we think about fiscal policy, I mean, it's a little bit of a run up, right, for that to happen. I mean, the election's got to happen, and then they've got to, Congress has to pass it, has to trickle through. But I would say that would change the climate a little bit. I can't imagine there would be any major changes. Off the cuff, I would say we would take a deeper look at things. We would stress test them, see how they looked, and if appropriate, make a decision. We tend to, my view is make as much money as you can, make money, as much money as you can. You have to pay taxes on that. If they raise capital gains tax, there are a couple avenues that we could look at. One is, the potential, what's called 1256 contracts, where it lessens the burden of short-term capital gains. So there we can take more short-term capital gains, which get the benefit of a blended return. You can Google 1256 contracts. We could look to more instruments like that. So we already have things in place that we could go to in that environment. So the answer is yes, we would make some changes, but we would evaluate the portfolios to see, if it was necessary or not.
That's good.
Depending on what the level is,
sure.
How it works. So
sure. Yeah. This comes, Ken, this comes from one of our advisors, Carter. He works in the Rockwell office with myself. He asked, one of our competitors is somebody that actually picks certain times, like they have like, hey, if the market does X, we're going to go to cash. And then when it does Y, we're going to go back in. What would you say to your opinion of firms that make those decisions to try to pick points and time, and kind of timing that situation? What is your thoughts on that?
So being in the stock market is better than being in cash a large proportion of the time. More than 80% of the time, you're better off being in the stock market versus being in cash. And so if you're going to get out of stocks and into cash, then you have to have high confidence that you've managed to identify that 10 or 20% of the time when cash will have a higher return than stocks. There's a lot of different things that people try to look at to decide now's a terrible time to own stocks. And there's some of them are flashing red right now. Valuation of stocks isn't really very good. So that's a warning sign. Volatility in the stock market is pretty high and the VIX is pretty high. Well, that's a warning sign. The economy is in a recession or still not all the way back from the recession we just had. That tends to be a warning sign. So there's certain things that we can identify that make it a sort of more worrisome environment for equity investing than usual. But none of the things that anyone can observe about the volatility or value or the economy, nothing that we can observe gives us a very reliable signal for when to be in cash or when not to be in stock. I mean, the warning signs that I just mentioned were all in evidence in April. And so you could have looked at these said, well, historically, when earnings are plummeting and I'm in a recession and volatility is high and the trend is down, then I should go to cash. But anyone who went to cash in May would have really been in bad shape. They would have missed out. So I have no confidence in anyone who says that they can be successful doing that. I guess is my bottom line.
Yeah, and you know what's great? I'm so glad you brought up that point, because Rob came to us in May and he's like, hey, we've got to change. We've got to make changes to the portfolios. Like, I mean, we were seeing the warning signs that you had, and that warning sign wasn't like, hey, let's go to cash. He's like, there's other asset classes that we can, look at to try to, maneuver through this. And and you want to kind of talk about some of those changes you made, Rob, since we're here and we got over 100 and something people watching right now. So, what kind of just a couple of those major changes.
Sure. And just to piggyback on that last question, that's a marketing strategy when you're trying to get in and out of the market. That's not an investment strategy. It plays on greed and fear. Some of the changes we made, we came in, there was a value tilt to the portfolios. There was a huge tilt to what we call value oriented stocks. And we made the decision, ended up being right. We made the decision to move more towards a blended type approach, to say, hey, wait a minute, we don't want to be, kind of like what I said before. What happens if we're wrong? Well, what happens if you're wrong just being in value, where you're going to miss out on a lot of growth? So we made the decision that we would rather own both, own value and growth stocks. Why stick to one? How do we know what's going to outperform? So we moved the portfolios from a value tilt more towards the center to a blend to include growth stocks, and growth stocks have taken off since March. And in fact, they've left value in the dust. That turned out to be a really good move. One of the other moves that we had done that turned out to be really good too was going to active managers. There was a lot of passive fixed income investments in the portfolio, which have done fine up to that point. They'd done fine. But in this environment, we want someone that can make decisions. We want somebody that can go in and make, interest rate decisions and credit decisions and those sorts of things. Those were the two main changes that we made to the portfolio, as well as doing a minor increase in the gold allocation. Ken had mentioned earlier, if we do have an inflationary environment, we don't think we're going to hit that now, but with monetary policy increasing, it did force the price of gold up. So we did add to real assets. In addition, another portfolio that we added was a manager that has the ability to make money when stocks go down. It's called a long short fund. So we added that to the portfolio. So, knock on wood, most of the decisions we made have really benefited the portfolios.
So probably sounds like, going back to your son analogy, it's going to be a bumpy ride potentially, but there, at the end of the day, we'll get there, over the long run. I mean, assuming that markets do what markets do, right?
That's exactly right. That's exactly right.
All right. This question's kind of for both of you. It's quite a few questions in the one. It comes from Mr. Price, but I'm going to kind of try to break it up in different parts. Number one is, do you foresee any changes in prime rate depending on who gets in the White House? That's question number one. Ken, I'll let you answer that.
Okay, well, so the Federal Reserve has made it very plain that they're going to prioritize employment over inflation. And to that end, they intend to keep short-term interest rates in the United States around zero for many years. It's hard to predict when they'll finally hit their thresholds for raising interest rates, but it would need to be some combination of our country getting back close to what they define as full employment and inflation kicking up over their 2% target. So if someday that happens, then we can expect the Fed might take action, but we shouldn't hold our breath. It's probably at least 3 years, could be 5 years in the future that short-term interest rates will still be zero. In which case, since the prime rate it tends to be a function of the short-term treasury bond rate or money market rates, then I wouldn't really expect that to be increased anytime soon.
Kind of a secondary question on that is, and this is kind of, I'm going to put all these questions into one. I have a lot of people that are concerned about future tax rates. So there's tax rates, we're talking about historically low marginal tax rates from, top to bottom. You're looking at historically high estate taxes, right? And then you're looking at the fact that there's been talk about them taking away a stepped up basis in long-term capital gains. Do any one of you want to kind of weigh in on your thoughts on, based on this election, do you see changes in those, different taxations on those three different levels?
Yeah, that's hard to say. If we do, there are strategies out there that we have that can take advantage of tax harvesting, for example. Strategies that in this tax environment aren't advantageous to do, but in a higher tax environment could be advantageous to do, because now your margin of error is much further reduced because you have a higher tax rate. So that is, Biden wins, higher taxes. Trump wins, lower taxes. So it's a coin toss. It's 50-50. So
we'll definitely be taking advantage of either one of those things, I think, but you're basically maneuvering based on that. And I think that goes back to what Ken said earlier. You don't want to be just like, hey, buy, hold, and hope. You've got to have that ability to be flexible on this. So that's good.
Exactly right.
All right. So one last question and we're done for today. This comes from Dan. Do you have any insight into mortgage rates? Kind of talked about what we're talking about here. Is there further expectations of rates dropping, and what are the major factors that you see, if any, influencing those rates? Rob, you want to do that?
Yeah, sure. So mortgage rates, the average mortgage lasts about 7 years. So there isn't a 7-year bond, so to speak. So mortgage rates tend to track 10-year bonds that expire in 7 years. And we have seen 10-year treasury rates dropping. They've dropped, unbelievably lower than anybody thought. So could they go lower? Yes. The answer is yes. If we have an uncertain climate, an uncertain election, we could see them go lower from where they are. If the economy starts to pick up a little more and we get a good election, meaning an election where we know who the president is and it's not disputed, then I would estimate that mortgage rates we've probably seen the lowest behind us, and we'll start to tick up.
Okay, so good advice for that. Well, Ken, thank you so much. Rob, thank you so much. It's been fun for a Friday afternoon in October, so I appreciate. I'm sorry, September. We're almost in October. We had a ton of great questions. Hopefully, you got some good information from today. If we did not answer your question, please reach out to your advisor and contact them, or feel free to email us at service@lakepointadvisorygroup.com, or give us a call, 214-771-3363. Thank you so much for this discussion today. We look forward to seeing you guys soon. Thanks so much.
Thanks for having us.